Hey, everybody. I was having a conversation with a long-term client, and I want to walk through what I walked her through. Fears tend to creep up at the worst times when it comes to investing. We tend to get really afraid when things look bleak. We tend to get overly confident when things look great. And it bears repeating the cycle that's going on in our minds psychologically, which is causing all of this. And I'm just going to add a little bit to it, talking about some of the brain science as well. But I basically said, hey, look, here's what's going on with you. People have a fear of the future. We worry about making bad decisions. We worry about what's going on overseas. We worry about, shoot, what's going on in Washington, what's happening with the president, what's happening here in this country, and how it's going to affect markets and our investments. So because of that, what we do, and we always say to ourselves, oh, it's different this time. This is just totally different than anything we've ever been through. And that's a trap too. Because if you look back through history, we've gone through some really ratty stuff historically when it gets down to it. And people still say, no, it's different this time. No, really. It's like, of course. So we have this fear of the future. And because of this fear, we want to predict the future. What's going to happen next? And I may not know what's going to happen next, but I can sure find somebody that seems to act like they know what's going to happen next. How do I do that? Well, I look at the past. I look at past performance, and there is no end to the people that will tell you, hey, I figured out when this was going to happen, this is going to happen, I figured out. And you have these experts or Wall Street legends, you hear about them that just have this ability to figure out what's going to come next. There was a thing about investment advisors, and they were using investment portfolios that were really academic in nature. Their returns way lower than markets, or way lower than the funds that they were actually using. Why? Because of this trap of thinking that they know what's going to happen next. And what happens, they look at past performance and they invest based on it. So if something does well, then they go, oh man, it's a good time to buy. And then when it goes down, they go, oh man, this is really terrible. We need to sell now. And it's just the opposite of what we should do, but that's the way we're driven. And then what happens is this. Past performance leads to information overload. I get overloaded with information. Everybody tells me that they're the best. Everybody tells me that they got the greatest research, that they're just the best thing since sliced bread. And as an investor, that's really, really rough, because what ends up happening is my emotions end up taking over. So we end up with emotion-based decisions. And again, fear is a big one. Greed is another one that kicks in. Another one is loyalty. I've just always worked with this fund company, or my dad worked for the fund company. My dad had his pension with his company, whatever. Loyalty kicks in. And then we also have trust is another emotion that tends to make us make bad decisions as well. Maybe we just trust blindly, as I often talk about. So these emotion-based decisions lead to us breaking the rules of investing. And I'll often ask somebody, say, you tell me the rules, because if you say it, it's true. If I say it, it's Paul said it. But, typically we know the rules of investing. We've heard them forever. And the reality of it is that when I'm doing what I know to be true, I don't have this cognitive dissonance, which is when you're doing something you know not to be right. It's a cognitive dissonance. So I said, you tell me the rules. And she goes, well, you don't buy individual stocks. And I said, good, exactly. If you think about individual stocks, it's like putting your money on every boat in the ocean versus just putting your money in one boat. Now, what's the likelihood that that one boat could sink and you lose everything? It's huge. Whereas if you put your money in all the different boats on the ocean, your likelihood of losing everything is, all the boats would have to sink simultaneously. Another thing was, don't try to time the market. So timing the market is futile. And when I go and put all my eggs in one basket, and which is diversification, I'm really timing the market. If I put it all in cash because I'm worried about what's going to happen in the market, I stick all my money in cash. That's a trap. Because if you look back through history and say, well, where did people lose everything? Think post-World War I Germany, where people had all their money in banks and they lost everything because the market became worthless, or Argentina, or, you just look at different countries around the world where they had hyperinflation, and you lost everything when they didn't diversify. And it's the example of Volkswagen stock. I use that as an example because if you think about it, if you had all your money in a German bank, you lost it all. If you had Volkswagen stock, Volkswagen's still going now, and it's a company. And if, let's say, it takes 20,000 marks to buy a Volkswagen, and then the mark actually drops in value to 1/5, well, they're just going to charge 100,000 marks for the Volkswagen, and then they're going to protect themselves. And you own the land, the buildings, the equipment, the machinery, and all of those types of things, which retain, that with stocks can retain their value because I own the company. So in essence, putting everything in cash or putting everything in stocks or putting everything in one type of company, putting everything in one sector, whether it be technology, whether it be energy, whether it be whatever, is very, very dangerous. So diversification, rule of investing, we know it. Don't own individual stocks. Don't try to time the market. Diversify, own bonds, because bonds are there for safety. Especially as you get older, you're going to own bonds to protect against market downturns. And these are all rules we've heard forever. So what happens, we break those rules. And what we end up doing is getting performance losses. And it's not necessarily a loss. If you look back at the average investor made, just a little bit less than inflation. If you look at asset allocation investors, whereas markets did that, didn't mean I lost money. That's not what happened. It's this relative loss that really gets us as investors. Now, what's going on inside of our minds in all of this? Well, you have the medial temporal lobe, or the middle of the brain, where you have this thing called the amygdala, and in the limbic system. And then you have this frontal lobe of the brain, which is where you're thinking, your logic, rational thought comes from. And especially when you're younger, that is not well connected. As we get older, the connection becomes better. And I've talked a little bit about this, how younger investors in particular are really handicapped when it comes to investing, because our fears and our bravado tend to kick in. And then what ends up happening is I don't really think through what I'm doing. And because that connection isn't so great, and the limbic system is perfect for protecting you against some kind of a danger that is immediate. Like, for example, a tiger's coming after you, and the frontal lobe of the brain doesn't react that quickly. And hence, we have to have that limbic system to respond to save our lives in some cases. Now, when it comes to investing, we tend to act on that. Unfortunately, we're not saving our lives. We're actually hurting ourselves when we react based on the limbic system without thinking through things. And hence, that's why the rules of investing are so important. Why I spend so much time teaching is to get you past some of that. But basically what happens is that we tend to react just like this, out of fear, out of greed, out of loyalty, out of trust. And it's fight, flight, or freeze. Maybe we fight, we think, oh, the market's going to go up, and then we jump in, or we flee, we run, and we jump into cash or something to protect ourselves because we see this impending danger or perceive that we're going to lose everything if we don't react right away. Or sometimes we freeze, which can be good, but in the reality, sometimes there are things you want to do even when markets go down, rebalance the portfolio and actions that you want to take. So understanding a little bit of how your brain works and how this cycle tends to cause us to lose money, and then we end up going back into the cycle over and over again, and hence the reason investors get such bad returns. So hopefully understanding this can make you a better investor, because we need better investors when it gets down to it. We'll catch you next time.